One of the other themes that sort of helped the market in 2023 was, I think, the expectation by a lot of investors that the Fed was going to, rush into 2024 and really start slashing interest rates. And that has not really been the case. This is Stan Barnes, and welcome to the 18th edition of Barnes Quarterly. Want to wish everybody, if I haven't talked to you, a Happy New Year. I hope it's off to a good start, and hope you had great holidays. I know there've been a lot of flu and RSV and COVID circulating around, so hopefully you've been able to steer clear of that. But we're coming off of a big weekend. It was Super Bowl weekend. I celebrated a birthday, and we're off to a fast start here at Barnes Capital. As far as what's been going on other than work, Eddie is getting ready to take off for the National Convention of the Wild Turkey Federation, where he'll be representing the state of Florida. Eddie, tell us what goes on at those things.
Yeah, it's just the annual convention that they have each year in Nashville. We get together and obviously have several meetings that we have to attend, talking about the different conservation issues that were going on and fundraising that we're trying to do, and have some discussions about things that are going on locally and nationally. Well,
it sounds like too they've got a pretty good lineup of some entertainment while you're there.
Yeah, they do a concert while we're there, and also have a big exhibit floor, so you get to go around and play with all the new toys and try the new things that you may or may want to buy.
And you're going to be taking a carload over there, right?
Yeah, the whole family's going, so they get to go and enjoy themselves while I'm in the meetings all day.
Well, that may be good for both parties, maybe. But. So in this episode, we're going to bring on Chris Zaccarelli and sort of take a look at what went on in 2023, good and bad, and what we're looking for in 2024, and get a little bit granular in terms of some of the sectors of the market that might have an impact on performance this coming year. So we're lucky to have as our guest, although, Chris, I don't know that I would really call you a guest anymore. You're pretty much a constant fixture of the podcast, but got Chris Zaccarelli on the line here with us, our Chief Investment Officer, speaking to us from North Carolina. How's everything up there, Chris?
Everything's going well. It's been pretty good weather lately, and I think maybe winter's almost over, so it's something to look forward to.
Well, very good. Well, I just wanted to know that we're here at the first of the year, and lots of people have been coming in and out of our office building here, going up to talk to the State Board of Administration, I guess, sort of handicapping what this year is going to look like. A lot of the investment bankers and portfolio managers from New York. But would like to hear from you just sort of about maybe give us a recap of how we ended up last year, 2023, and sort of what you're looking for in 2024. And I'll get more specific with that after I give you a minute here.
That sounds great. Definitely happy to be on the call again. I know we've been doing this quarterly for a long time now, and I feel like it's always nice to kind of take stock of what's happened over the past 3 months, or in this case, past 12 months, and really kind of look back on how 2023 turned out and potentially where things are headed for 2024. As far as 2023 goes, clearly a much better year than almost anyone was expecting. As a lot of you remember, the end of 2022 was a really tough year. Stocks were down, bonds were down. It seemed like the Fed raising interest rates was going to cause a recession, and really the market pain was going to continue. And very surprisingly, in 2023, we saw the market start to rally almost immediately in January, and it really never looked back. There were some pullbacks along the way. There was a regional banking crisis, very short-lived, but in March of 2023. But the Fed really ring-fenced a few of the banks that were having trouble, and the market recovered and really never looked back. So I think, there's some really big themes for 2023. First of which I would say is just the resilient consumer, the fact that consumers kept spending for all of last year, kept corporate profits up, kept GDP growth up. And, whether that was because unemployment stayed low or because spending allowed corporations to keep making money and that allowed them not to lay people off. But we did not see a real rise in unemployment. We didn't see really a slowdown in consumer spending. And as a result, the recession that so many people believe would happen in 2023 never came to pass. And so I think one of the big reasons you saw the stock market have as good a year as it did last year was that at the end of 2022, the stock market was pricing in a recession. And then when it became clear that no recession was coming, at least not for last year, you saw the market recoup all of its losses and then start to add to gains. And so it was a really a pretty amazing year in terms of defying a lot of what people expected would happen.
Yeah, and I think most people got their year-end statements and ended up being pretty happy with it. But obviously I think you still had a lot of power in the NASDAQ and specifically the Magnificent Seven. Talk a little bit about that, if you would.
Yeah, last year, definitely at the index level, you saw the S&P 500 do very well. You saw the NASDAQ, which is the tech index, do even better than that. And I think, within those indices, you could see the highest weighted companies, those really large companies like Apple, Amazon, Microsoft, Google, et cetera. Those companies did exceedingly well last year, significantly better than the average. And because they're such a large percentage of the average, those very few companies, let's call it 7 out of 500, give or take, for the S&P 500, really powered a lot of the gains for last year. Now, again, I would point out, first of all, that those same 7 companies had a terrible 2022. So part of the reason you saw them do so well last year was they just had a lot more ground to make up, a lot more ground to cover for the losses that were made the prior year. But ultimately, with the economy doing well and with people continuing to spend, those companies also did very well. Their fundamentals were very good in terms of profits and revenue growth, not just the fact that their stock prices did well. And so there was a lot of narrow concentration. Not all 500 stocks went higher. If anything, probably less than half of S&P 500 stocks could even point to relatively good results. But at the end of the day, those 7 really large companies, predominantly technology companies, or companies that are classified in other sectors like Google or Amazon, which I still consider to be tech companies, even if technically they're put in other sectors, really drove the market forward. And as we look to 2024, at least in the beginning of the year, we've seen a little bit of that continue into the next year. And I think 2024 is going to be one of those years where, we'll have to see if what everyone was worried about last year just got postponed, or if we're actually in a slightly different trajectory. And so I think the jury's still out. It's very possible that with high interest rates and with all that the Fed did, it is possible that the recession has been postponed from 2023 to 2024. But for all the people who say that, I would just caution them that, there is something a little bit different going on. The fact that unemployment really didn't rise last year, consumer spending stayed very resilient last year, we're still seeing a lot of signs of that right now this year. So I would just caution against the idea of just saying what we all believed at the end of 2022 is still going to happen in the immediate future. I would say, it's very possible that we're experiencing a slightly different path. Obviously, you always have a recession. This bull market will end, and this economic expansion will end. We're not calling the death of recessions or the business cycle. But what I think is important to really think about and to consider is that it's very possible that all of 2024 goes by as well without a recession. And so without a recession, I think the stock market just historically will do a lot better than if there is a recession. And there can be pullbacks along the way. At some point, we'll probably talk about some of the market action, this afternoon. But, in general, the stock market will pull back about 5% on average every year. And it'll come back double digits, call it, 10, 12% every other year. So it's not unusual even in the middle of the bull market without a recession for the stock market to drop, 10 or 12%. It doesn't feel good when it's happening, But there's a big difference between the stock market falling, that much amount in the middle of a bull market where it quickly resumes its upward trajectory and continues along those lines, and the case where a recession is beginning and the stock market, will go down quite a bit more than 12%. Some would say closer to 30% on average for most recessions. So there's a big difference between the two, and that's why we care economically, whether we're still in an expansion or whether this business cycle is coming to an end.
One of the other themes that sort of helped the market in 2023 was, I think, the expectation by a lot of investors that the Fed was going to, rush into 2024 and really start slashing interest rates. And that has not really been the case. Maybe talk a little bit about what Jerome Powell has said so far this year. And it kind of was a little amusing to me. The guys on CNBC were giving him grief for taking an interview on 60 Minutes, and where he should have been talking to CNBC. And I think he did that with a purpose to probably reach those people that don't watch CNBC, who were already sort of in the know. But at any rate, talk a little bit about interest rates and sort of what we might see this year and how that might impact the broader markets.
So yeah, I think you're exactly right. Clearly, 60 Minutes is going to hit a much broader audience, not necessarily the kind of people who are watching financial news, day in, day out, and are looking at the stock market, for every minute of every trading day. So clearly Jerome Powell had a wider vision. In his mind, the Federal Reserve is not just about making the stock market go higher. As we all know, that's not at all what it was created for. Ultimately, the Federal Reserve is just really trying to do two things. Try to keep maximal unemployment, keep unemployment as low as possible, given the situation on the ground, while still keeping inflation in check. Really, they only have two things they have to worry about: keep inflation under control and in a meaningful, in a predictable fashion. For a very long time, they've used 2% as their target, and that's right around where they're trying to keep inflation, but also keep maximum unemployment. And so to some extent, those two are at odds with each other. The lower you have interest rates, the more likely you are to have the higher chance you have of higher inflation, and the higher interest rates are, the higher chance you have of higher unemployment. So there is a trade-off between inflation and unemployment. They're not directly correlated, but there's definitely very much intertwined within the context of a business cycle. So I think what Federal Reserve Chairman Powell is trying to do is communicate that the Federal Reserve is really trying to get the economy back to a sustainable path. Their number one goal for the last 2 years has been to get inflation under control. To some extent, they've been doing that. They're not at their 2% target, but inflation was above 9% back in the middle of 2022. That was a really bad trajectory that inflation was on. And since then, it's come back down. So now, really the question is, can the Federal Reserve get inflation back from 4% down to 2%? Or are we going to get somewhere stuck in the middle? And so I think a lot of people were expecting that the Federal Reserve had conquered inflation. They had achieved their goal last year. And so that interest rates were artificially high and they needed to start slashing rates immediately. Personally, we never were of that view. We always thought that inflation was coming down, but that, it's not one of those things where it can just turn on a dime, and it's never typically a linear path. Things don't just go up and then come straight back down. There's typically bumps along the way. And so we were concerned there could potentially be, at least the idea that inflation would get stuck or would stall out at a higher level, and a much smaller chance, but a non-zero chance that inflation could actually start going back higher again. And fortunately, we haven't seen inflation really go back higher. But one of the things that Jerome Powell was really pushing against was the idea that the Fed was going to be cutting rates as much as the market was hoping it would cut. At some point, I think the market was expecting 6 rate cuts. The other thing was the market was expecting the Fed to come into the year and start cutting rates pretty quickly, as you mentioned. And so there was a pretty high percentage chance. I want to say I saw a 75% chance of a rate cut in March, at least as of the end of last year. Now, Chairman Powell in his press conference just the other week pretty much said there's a very, very small chance of March. It's very, very unlikely. So the market has finally come around to his idea that, the rate hikes might be later in the year. But the market was still pricing in, I want to say, around 5 cuts, even as recently as a few weeks ago. And so it's our view that, the Fed is going to be very careful. And Jerome Powell has said this to some extent. They definitely don't want to keep rates too high. They don't want to cause a recession unnecessarily. They do care about keeping unemployment low if they can. But on the other hand, just because inflation has been coming down doesn't mean that it's going to go all the way back down to target. So what he'd been advocating was just to be patient. He wants to keep interest rates where they are. He doesn't want to be raising interest rates anymore. And hopefully they won't need to do that. But he isn't in a rush to cut rates. He said we can expect some rate cuts in 2024. Personally, we were expecting more 2 or 3, not 6. And we were expecting them to be, more along June, July, not March. And again, the reason for that is just the Fed wants to just wait a little bit longer, be patient, make sure that inflation is coming back down before they start cutting rates. And so that was a little bit of a disconnect between, I think, what the stock market was expecting and what Jerome Powell has been communicating.
Okay. Well, one of the questions that I've gotten a couple of times, is about specifically the commercial real estate market and what sort of ripple effects the difficulties that sector's having might have on the rest of the market, the rest of the economy. Can you talk a little bit about that?
Yeah, absolutely. One of the things that people start getting concerned about when interest rates are going higher is real estate. Not only do ordinary investors or people who are out there buying homes have to contend with higher mortgage rates, if and when they switch houses. But commercial real estate, unlike most residential real estate, they don't typically get a 30-year mortgage at a fixed rate. Most commercial real estate is done with 7-year terms or 5-year terms, whatever it may be. It's always a little bit different, but significantly less than 30 years. And so for that reason, if interest rates go higher and, there's always mortgages that are rolling off within commercial real estate, you see a lot more refinancing activity, a lot more quickly than you would within the residential real estate market. In addition to that, it's typically the case that, within commercial real estate, you're just not seeing as many transactions. The average person may move homes many, many times, whereas, a lot of the commercial real estate projects, don't change hands that often. And so with higher interest rates, there's always the risk that either people who own the real estate are unable to refinance at higher levels, and if they do, it'll hurt their net income, or it'll hurt their operating model. Or it could be the case that, for whatever reason, someone wants to sell their commercial real estate, and clearly the next buyer is going to have to give a lower price for that real estate if their financing is much more expensive. And so that's really where the concerns lie, I think, at the first level. Now, at the second level, you have to say, well, who are all the people or who are all the institutions that are most exposed to commercial real estate? And it turns out that most of the commercial real estate in the United States is really originated by regional banks, so some of the smaller banks. The really, really large banks, the money center banks like J.P. Morgan, Citigroup, Wells Fargo, of those size, J.P. Morgan, they'll have commercial real estate as part of their loan portfolio, but it might only be 2 or 3% of their overall business. Whereas within regional banks, in some cases, it's 20, 30, or even 40% of their overall business. So when you talk about commercial real estate potentially having some problems, it is possible that you'll see issues within the regional banks. And keep in mind that each regional bank obviously is exposed to different parts of the country. It really will depend on which parts of the country are experiencing more distress or less distress within commercial real estate. And it's also important to think about the fact that not all commercial real estate is treated equal. If you have a office building and the majority of people are working from home now and not working in the office building, that's a problem for commercial real estate. But if your commercial real estate is around a medical office or a doctor's office or a hospital, it's very possible that the demand for those types of buildings are not only as high now as they were a few years ago, but are continuing to increase, because despite the fact that interest rates are going higher, as a society, we're really seeing our population age, and we're seeing increasing needs for healthcare, not decreasing. So that's just one thing to think about. The other thing I would say is, you look at warehouses, you look at anything that has to do with shipping, people buying goods over the internet and having them, shipped to your home. That's clearly a trend towards greater demand for warehouse space, greater demand for commercial real estate when it comes to working with online ordering, shipping, logistics, things like that. So you just have to remember that commercial real estate is a very, very broad term, and not all commercial real estate is treated equally. And then lastly, each regional bank is going to have a different approach to how they finance those properties and the types of properties that they have. And so, I'm sure there's going to be some banks which are heavily levered to the wrong types of commercial real estate, the kinds that are distressed. There'll be other banks that have done a really good job of being very well diversified, or either through luck or through, good skill, good insight, potentially are less exposed to some of those more troubled aspects. So it's something that's worth keeping an eye on. And, if you want to look for direct impacts within the investment portfolios, from an investment point of view, we've to a large extent avoided investing within regional banks and have focused a lot more on either the larger banks or even in other areas just outside the banking system in general. So that's one example of where I wouldn't say we're extremely worried about commercial real estate, but we do understand it is an elevated risk, and in a high interest rate environment, one where interest rates stay higher for longer, it's something that could potentially become a problem down the road.
We mentioned the Magnificent Seven a little earlier, and back when they were called the FANG stocks in 2022, and they took a big hit. Most of that seemed to be due to the rising interest rate environment. With that not being as much of an issue, do you see those continuing to push the market forward? Or are there potential headwinds against those particular companies?
So, for those particular companies, those really large stocks, as you mentioned, and as we were talking about, those were the ones that went down the most back in 2022. They're the ones that bounced back the most in 2023. They are great businesses. They deserve to be sought after and owned by a lot of people. So I don't necessarily think it's a fad to be investing in those stocks. But what happens is, no matter how good those stocks are, no matter how good those companies are, at some point the price just gets higher and higher. And so unfortunately, by the end of 2023, they're a lot more expensive, not only their actual price, but their price earnings ratio or other metrics of looking at valuation. And so the more expensive those companies become, or the more expensive the stocks of those companies become, the more they're at risk of either a market downturn or they're at risk of just disappointment in their earnings. So I would say, at the end of 2022, clearly in hindsight, they were priced so cheaply that, you could do really, really well by owning them. At the end of 2023, I would say a lot of the good news is in the price. And so for 2024, I really think it's going to come down to, how does the economy unfold? How does earnings and consumer spending and unemployment, play out over the course of this year? All of those companies are still great companies. I don't expect that to change. And I think for many of them, the stock prices were a lot more fairly priced in the middle or towards the third quarter of last year than they were at the end of 2022 when they were, clearly too cheap. Now, as we head into the end of 2023 and beginning of 2024, clearly they're not nearly as much of a bargain as they were in the past. And so, I would expect that those businesses will continue to do well. But, whether or not the stocks, continue to appreciate really is going to come down to earnings and the economic environment. All of the lift that you got from bouncing back from a artificially low price, one that was pricing in a recession, that discount is gone. And now you're back to more fully valued companies. So that's something where, whereas it may not have hurt to have been heavily concentrated in those companies at the end of 22 and for most of 2023, now I would say it may make a little bit more sense to be diversified because, the market will go higher if they go higher. but you're much more likely to see a broadening out where more stocks are a greater number of stocks are able to push the market forward, or vice versa. Ultimately, if you can't get the broader stock market or a broader number of companies having their stock prices push the market higher, I think it's going to be a lot harder in 2024 to see anything like what we saw last year, unless you see more participation from stocks outside of the Magnificent Seven.
When you were here, I guess last year now, you spoke with us a little bit about the excess savings that different income levels had to be able to spend. And you were showing a chart that showed that the majority of income earners, I think the bottom 80% had already used up most of that excess cash. Do you see that becoming much more of an issue now, or have we started working through that? Is that a big headwind that you see coming for the economy?
So, yeah, I think that's a really good thing to think about in terms of, during COVID, there was the savings really built up. Either the government was, giving out a lot more money than they typically would. They gave out around $2 trillion during COVID in many forms of government programs, fiscal stimulus, and a lot of that has been spent down. So a lot of that excess savings, at least in the aggregate across all consumers, has been used up. So on the one hand, I would say, that potentially could be a good thing from an inflation point of view, to the extent that you believe inflation was caused because there was too much money chasing too few goods. If you get that back into balance again, it's possible that inflation will stop rising at as quick a rate and may actually start coming back down a little bit, or at least be at a less elevated level. On the other hand, clearly that cushion is gone. So what I would say is, as long as unemployment stays low and people are still collecting a paycheck and still have good credit, they can continue to spend. Even though those excess savings are gone, it doesn't mean that you can't have economic growth and you can't have a robust and growing economy and therefore a robust and growing stock market. However, if you see unemployment just start to go back up and you see people start to lose their jobs and not quickly find new jobs, I think a lot of that cushion is gone. So I think you're much more likely to see a more immediate reaction between higher unemployment and lower consumer spending. And so for that reason, I think about it more in terms of the safety net has been pulled away and less in terms of excess savings being gone means ultimately the economy can't continue to expand and the stock market won't go higher. So that's more how I look at it.
What do you see for the bond market moving forward? Is now the time to start locking in higher interest rates, or do you have some thoughts on where we should be paying attention there?
So, as far as the bond market's concerned, at least how we've been running our portfolios over the last couple of years, we've been staying a little bit shorter duration. So what that means is rather than lending money for longer periods of time, 10 years, 20 years, 30 years, we've been focused a little bit more on 1 year out, 2 years out, 3 years out. And so what that does is that allows you to be a little bit less interest rate sensitive. The way bonds work is the longer your duration, the more sensitive you are to changes in interest rates. And the shorter duration, the less sensitive you are to changes in interest rates. And so one of the things we've seen over the last few years is that interest rate volatility has been very, very high, much, much higher than normal. And so, that works both ways. If interest rates go up very quickly, then the price of your bonds, if you're longer duration, will go down a lot more quickly. But on the other hand, if interest rates go down quickly, the longer duration, the more money you can make. And so we've just basically taken a less risky approach. Literally, we're willing to give up more of the appreciation in the price of our bonds if interest rates come down, because the trade-off for us is we'd rather not be as exposed to interest rates going higher. And so, that worked very well in 2022 when interest rates went a lot higher. It worked less well in 2023 where interest rates were, for the most part, coming back down. But if we start talking about what's been happening in 2024, we're still seeing a very volatile interest rate environment. And so, what I think is one of the biggest changes from, around the global financial crisis in 2009 to when COVID began in 2020, where we had very low interest rate volatility. If anything, interest rates were artificially held close to 0% on the overnight levels, and all of your longer term bonds were relatively low because short-term interest rates were so low. We've seen an explosion in bond volatility between 2020 and the present. And so for that reason, we've largely been staying cautious. I don't think it's truly going to be business as usual or what we're used to in the bond market until we really figure out where inflation's going. To the extent that inflation does go back to 2%, things are back under control, the Fed gets back to a more normal interest rate environment, that's when I think you'll see a more normal bond market. And that's where I think, you can more safely go longer term. Right now, while we don't know whether or not inflation is under control, I think it makes sense to just be a little bit more cautious. Our philosophy has always been to try to take risks where they make sense, but otherwise try to be a little bit more cautious. And the bond market is one of those areas where we've traditionally been a little bit more cautious, and that's served us pretty well during the last few years when things have been difficult in the bond market.
Well, Chris, we really appreciate your time, and obviously, probably everybody is thinking about a big event coming in November, but I think I'm going to save that until the next quarterly podcast. But the presidential election is obviously coming up, and I know everybody's pretty focused on what that's going to mean to their investments in the markets. But again, thanks for your time as always, and hope you have a great rest of the week.
Thanks. Always good to talk to you, and I appreciate all that we've been able to cover, and hopefully we'll be talking again soon.
Chris Zaccarelli of Independent Advisor Alliance are independent entities and not related or endorsed by Barnes Capital Group or LPL Financial. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including the potential loss of principal. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful. Dollar cost averaging involves continuous investment into securities regardless of fluctuation in price levels of such securities. An investor should consider their ability to consider purchasing through fluctuating price levels. Such a plan does not ensure profit and does not protect against loss in declining markets. Asset allocation does not ensure a profit or protect against loss. This material contains only general descriptions regarding insurance needs and products. This content is not a solicitation to buy, sell, or replace any existing policy. Please speak to a financial professional regarding your specific insurance needs prior to taking any action. All performance reference is historical and no guarantee of future result. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individuals. To determine which investments may be appropriate for you, consult your attorney, consultant, financial advisor, or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance, a registered investment advisor. IAA and Barnes Capital Group are separate entities from LPL Financial.